Hey, good morning, everyone. Marty Missouri here, Friday, the 14th of October, 2022, with I think, a relatively brief stock market snapshot for you. Like I've been doing now just about every Friday, I'm separating the economic update from the main market snapshot. Depending on when I bring the economic update to you, I may or may not add another market snapshot at the end. Depends on also what happens between here and there. So I want to start on the long-term chart. Interesting development yesterday from the technicals. Recall that we were way back, months and months and months ago, we were recognizing that when the moving average convergence divergence hits with a sell signal on the monthly chart, which are not very common. I dotted line that one because that one, almost didn't happen. And you get these bearish or negative divergences on the relative strength index, as well as typically on the MACD too. Outside of recessions over the last 30 years, you look for the correction or the bear market to bottom at the 50-month moving average. These three areas are actually recession. So where it's most prominent is once we get out of the great financial crisis of 2008 and we work our way above that. Notice the green line here, how supportive that is on these MACD sell signals, right? Sell signal, support, bottom, sell signal, bottom. Even during the very steep recession, COVID recession we'll call it, that was just a blink of an eye time-wise because of all the stimulus that was brought to bear. Even that one on a closing basis, even though we were in recession, closed or bottomed right on the 50-month moving average. So back in here, my assessment was based on this particular indicator that 3,500 made a lot of sense, predicated upon the notion that we would not have a recession. We think we will have a recession, although we think it'll be a mild recession. But so our 3,500 bottom target there is very much in question because of recessionary forces and what that does to earnings and so on. Yesterday, however, it just basically stopped cold, just a hair below that, and again, you will overshoot, and then bounced violently off of that amid what was really bearish CPI data, right? So I think technicals were in play. As we've been talking about, we have some insight these days into where options dealers are positioned, and there was this quote put wall, a big concentration there at 3,500 that ironically, because that was that number we established, that turned into support as the market bounced. As I wrote in this morning's note, dealers had to cover their hedges, their own hedges. Those who are short or who have sold the puts have to short the underlying, and short interest ultimately has to be covered. I've been showing you in most weeks noticeable net short interest in the S&P as of last week, even on the NASDAQ, which had been holding up with net long interest in the futures market and so on. So there was the potential for a massive short covering rally, and then sentiment has been very, very sour. So we'll continue to watch that. Interesting developments today, which I'll get to as we get to the shorter term charts. Okay, so we'll just drop down to the weekly as well and just work our way back. So on the weekly chart, we did a 30-year analysis as well, and came up at the time with about the same price target, and it was on that 200-week moving average. If you go back historically, that seemed to be where it stuck, but that continued to rise, and we breached that. So that was actually a higher level, and it bounced off of that, and again yesterday came down to the 3,500 price target. What is very interesting, though, on the weekly chart is you have these you have this pretty bullish looking setup to me. You have a falling wedge pattern, right? And you have some real definite divergences. I mean, technically you want to see the white line move up over the red line here for the MACD, but you definitely have it in the RSI. So that's encouraging. You do have that bear flag pattern that I pointed out that's played out, and maybe the makings of another one. So again, our base case has to be that we probably test these lows and breach them at some point. Lots of reasons to think that maybe we could get a little reprieve here, seasonality, and so on. However, the action this morning is, as I speak, is calling that into question. The 1-year daily chart and had kind of this ominous looking bear flag right here. However, yesterday was absolutely amazing. This is about as strong and engulfing candle as you will ever find. So you take the top and the bottom of a candle, and when it engulfs, meaning it captures in its body the previous days, it's called an engulfing candle, and it can be, technically speaking, a pretty strong reversal indicator. These things tend to happen at the bottom of corrections, at the bottom of bear markets, and so on. And we're saying that this bear market may have a bit more to go, but that was a very, very strong, very impulsive with momentum that had carried through pretty impressively this morning until, I want to say, the University of Michigan sentiment survey came out. So the first time in several months, consumers actually upped their anticipation of inflation 1 year out. And I can tell you, without question, it's tied to gasoline prices, which have begun to ramp back up on them. So you know why the Biden administration is so upset over the recent decision on OPEC. And so consumers are very, very sensitive to the cost of gasoline. So that just really turned the market around. We were up 1% early on. News out of the UK kind of got confirmed today, and we talked about that on the blog a little bit here as well. That was bullish, but as I speak right now, the S&P is actually down about 1.45%. So we were down there earlier, tried to bounce off of that. We're testing those levels again. The VIX is elevated a little bit, 2.75%. That's not dramatic. There's nothing panicky in today's action. The other thing I think I should point out here, and I'm getting kind of busy here, let me erase those lines and start over. Notice we had this gap right here, and gaps tend to get filled, but you can also get resistance at the top and bottom end. So this morning we jumped right to the bottom of that gap for a few days ago. It's not unusual that would be an area of resistance. And if you draw that back a ways, you can see right here, bottom, boom, right there, formed a bottom there, breached it and then came back up. So that is a level that you would expect maybe the market to gyrate a bit, and that's exactly where we gave up the ghost this morning. This is on the daily very encouraging because you got the buy signal here on the MACD, so that confirms this positive divergence. And you got it here on the RSI, although if today continues as it is as I speak at you right here, well then this could just get kind of blown out, and in short order get below that 3,500. Keep in mind, folks, though, we came into this stretch here with extreme fear, as our fear gauge suggests. Everybody kind of loaded up on the bear side of the boat. Something that could be viewed as a positive, like the news out of the UK perhaps, or just bouncing off of a technical level and all this short covering, could have people freaking out, fear of missing out, and they rush in and buy. Apparently this morning's consumer sentiment index was able to send people drifting, back over to the bear side of the boat. So let's put it this way: volatility is here to stay for a while, no doubt about it. And then lastly, on the hourly chart, we had this falling wedge, very distinct bullish divergences. You want to take that one from here. You see how we have a lower low and then we have a higher low on the MACD. Had a buy signal. That is pretty classic. I know I've been telling you that's a pretty unambiguously bullish setup. Broke through that. We had this amazing breakout with momentum that you'd really think, coming off of these patterns, as aggressive as yesterday's rally was, it made sense to me that there was follow through this morning, but clearly this market is intensely jittery. So the market is listening to the Fed, how important inflation expectations are, and that there's nothing that would have the Fed letting up here. But I will just say this in closing, that yesterday's rally was about technical level getting hit, a ton of short covering, fear of missing out as the market began to bounce. And then the prospects for maybe some of this systemic, breaking of something, a la, the pound and the UK pension system, right? And that filtering over. And then Janet Yellen's comment day before yesterday that, and I posted this, that she's worried about liquidity in the treasury market, right? These are, as we've learned, there could be some heavily levered players that are swimming naked, as I said in yesterday's video, that actually could create something big and disruptive in the markets. And so I think maybe equity investors are seeing that, maybe the Fed has to start thinking about that. Well, as we, suggested way back when, I think it was last year's year-end letter, and even before that, when we look at kind of the historical analogs to where we are today, to us, it really feels like the 1940s, which was the last time we had government debt north of 100% of GDP. That's problematic, particularly when a lot of that debt was piled on the last couple of years in very short-term bills, T-bills. I mean, you could borrow at zero, so the government did on the short end of the curve. That stuff comes due. In a higher interest rate environment, that becomes very problematic for the federal budget, right? And so in the 1940s, we had this big debt. We had the rebuilding after World War II. So we were going to run big deficit spending. So what the Federal Reserve actually opted to do is what the Bank of Japan has been doing, and it's called yield curve control. And that is capping interest rates at a certain level. And when you think about how the U.S. ultimately defaults, not technically defaults, but defaults on its debt historically, like in the 40s, it does it through inflation. So there is this longer term strategy that gets us out of this 125% debt to GDP, and that is allowing inflation to actually run higher than what nominal interest rates are. So two things go on there. You inflate away the debt, which worked in the 40s and into the early 50s. And you also keep potentially these systemic crises from happening by yields just blowing out and having some levered player blow up on you, like the UK pension system almost did. So folks, lots to parse there, right? But when we think deeper under the surface, listen to this Fed, and we're going to stick it to inflation, we're going to do that. You say to yourself, oh, really? You do that, you push yields too high, and you get something to break. Things are going to roll over hard on you really, really quickly. And that is what we just saw happen to the UK's new administration, the Bank of England, and so on. And they've been having to change course, almost within the day in terms of what they're going to do. And that happened again. Just I listened to Liz Truss. She's the new UK Prime Minister, talking about having to back away from these tax cuts that they promised because of what that did in the markets and at a time when they're trying to fight inflation and yada yada. So something began to break, and it happened to be a very levered UK pension system around all of this action. And so that had an impact last week and early this week on global markets, including here in the US. So again, back to Janet Yellen's comment, that's the kind of thing she's talking about. She's worried about liquidity in the treasury market. Why would you be worried about that? Well, because yields spike because of a lack of liquidity, and you could have some major underlying problems develop. So anyway, I know I got to rambling there at the end, folks. Sorry about that. I hope it's useful, and I know it's really into the weeds. Those of you who stick with me on these videos and read the blog, I really appreciate it. And you can always reach out to me via email with questions and say, Marty, I want some clarification. You said this, this, and this. What do you actually mean by that? Right? You can do it directly, email at marty@pwa.net. You can comment on the blog. And those of you who catch this on YouTube, maybe, mentioned something there in the comments. Happy to have as many people listen to these messages as possible. But really it's designed for our clients, so it shows up on the blog, they click on it there. And as you've noticed, not a whole lot of people do, but that's okay. The ones who do seem to be getting something out of it. And the feedback I often get is, it's kind of over my head, it's so technical, and I get that, and I totally understand it. And if it's not useful for you, do not watch it. If it is, and there's some points that seem somewhat confusing or a lot confusing and you need some clarity, I promise you, I will answer anybody's question, via email or however, and do my best to give you clarity. It's not my intent to give you some complicated message that you can't really understand. Hopefully, underneath all of this complication, you get the gist of what I'm thinking about market dynamics, short-term and long-term. I'll leave it there. Next up is our economic update. Folks, really appreciate you lasting this long in these videos. Hope you have a great rest of the day, and I'll talk to you again soon. Bye-bye.